Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. So what's going to turn this rate story around? We posted to our social media thread over the weekend, got a lot of nice comments from some extremely smart and well thought out friends on LinkedIn who know that we've been in general bearish with periods of consolidation and pause along the way, and certainly bearish with this last leg higher. We go back to context. I mean, there really are no magical levels here. For rate levels in general, we go back to the last significant hiking cycle that we had, which was, if you look at the period of 06 and 07, we had a 10-year nominal yield between 5.25 and 5.5. We had a Fed funds rate roughly around here. The Fed stayed on hold for 18 months, and then we know what ensued from there. And then we had a big steepening of the yield curve, obviously, when the Fed is lowering rates. And that's typically how we would see a steepening in the curve. It's typically done in bull fashion. And now people are saying, well, we have a bear steepener, and that can't be possible. But it can. And if you look at the story, if you look at our story, a lot of what we've written about is, one, the neutral rate, which we think the Fed is talking more explicitly about. We can, unlike the Fed in this window of time, be a little bit more vocal about the fiscal side of the equation. And we haven't been shy about it. And it doesn't really matter what political party you belong to. If you look at the pure math, the pure numbers, if you look at how well the economy's been doing and the amount of spending that we have relative to this period of time, it's clearly an issue, and the market's taking note of that. And then the Fed stepping away, running off the balance sheet for the first time in a long time, coming from extremely high levels. Former New York Fed President Bill Dudley wrote, I thought, a very good Bloomberg piece recently where he discussed the dynamics around term premium, what the Fed's doing in the balance sheet, the need to continue to run this balance sheet lower, that there is certainly more room to go, and we see what's going on in the RRP. And so far, so good, which is good. But for a long period of time, we had the exact opposite dynamics. And we not only had a Fed that could try and normalize policy, but was maybe in a position to do that at some point. And now we run into dynamics, not just here, but globally, where it's just becoming tougher and tougher for some of the dynamics that we saw historically implement themselves now. And case in point was March of 2023 of this year, where certainly rates were the driver of the main driver of the issue. But at the same time, we saw the Fed use 13.3 programs on one hand, and then on the other hand, continue to implement monetary policy in the terms of rate structure and bring the balance sheet down. And this is critical here in this point in time. These dynamics are much, much different. For years, almost maybe 2 decades, the suppression of volatility, the suppression of term premium. What does a normalized curve look like? What does normalized term premium look like? I don't think we have the answer to it. But what we're seeing in this yield curve right now is starting to give us some clues and examples in terms of how we can normalize on the back end, how the Fed can tell us that they're probably close to being done, and we can have a curve coming off extremely low, deep inverted levels and begin to normalize itself really to levels that we were at in 2006, 2007. We did have a curve that was slightly positive to flat. So are the dynamics different in this pocket of time? Clearly, people want to go back 20, 30, 40 years, and you certainly can. But how much can this economy really take? How much can the market, the financial system take? And this is what we saw back in 1994, where the Fed raised rates extremely aggressively and had to bring them down ultimately to support the economy. So far, we're not seeing the pain in the economy. My view has been long and variable lags. I think those lags, they do take time. We're starting to see things kick in, like people being late on their auto loans and the cost and structure of what things, certainly housing, we know the dynamics which are going on there. But the reality is, the consumer has held up fairly well. Our view going forward is that dynamic is likely to change, but how fast and how much it changes, that also matters. So, and then the financial system, how will the financial system handle these higher rates and the potential for rates to go even above 5%? Now people are already talking about 6%. And I think we saw a little bit of that in March of 2023, not that we're looking to speculate here. So what turns around the higher rate story? In the end, as we wrote to clients this morning, higher rates may be the answer to higher rates. Ultimately, one of two things can happen. Certainly, we could see more breakage in the marketplace, which we're not hoping for. Breakage could lead to breakage in the macro story, or the macro story could slow down as a function of what's going on the monetary side. But certainly, I think when you look at the fiscal side of the equation, you can't ignore the contribution that we're getting there, the need now for the Fed to probably stay on hold, to maybe slightly go higher in an environment where the financial system is showing cracks and vulnerabilities. So could we see breakage that breaks the back of the macro economy? It's very plausible, but we're going to see in one way, shape, or form, it's likely that we will need to see a change in the macroeconomic environment to really solidify some sort of shift in tone in this rate market. And I think the focus for a good part of this tightening cycle has been in a logical place, which has been the labor market. But we're still weaning through dynamics coming out of the pandemic, both on the fiscal side and also what we're seeing, on the consumer side, that is making it more difficult for the Fed to get the result from an economic perspective that they'd like to get. So the risk in the end certainly points to the financial system again, in our view, especially with 10-year yields in and around these levels, again, with the potential and not finding that catalyst to turn things around. On the ground this week, PCE deflator, we'll be watching the month-over-month numbers. That's where we think the Fed's head is going to be at, the core numbers now. Overall core expected to come down. And then we'll also get a look at third quarter GDP, and we have a slew of technology earnings as well. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.